let's begin our journey with liquidity, one of the cornerstone concepts of the smart money approach. Essentially, the entire methodology rests on two fundamental pillars, liquidity and time. We're starting with liquidity because every example in this course and all subsequent knowledge will in one way or another build upon it. Right now, our key focus is learning to view charts through the lens of the algorithm, through the prism of liquidity. We'll take it step by step to fully grasp the critical concept. This foundational understanding will shape how we interpret all the other elements of the price action throughout the course. Here, the algorithm signaled a short to everyone. They opened short positions and placed their stop losses here, as that's the common practice. Technical analysis suggested some might place it slightly higher to avoid getting stopped out before the move continues in their favor, but generally liquidity will consolidate right here. This is what constitutes buy-side liquidity, because these are the stop losses of short positions. Then the price returned here, took out these stops, and also swept the pending orders of those trading breakouts. Breakout trading isn't just done by retail traders, funds do it too. In fact, it's probably one of their primary strategies. It's not as simple as they make it seem on YouTube, but the basic principle holds true. Here, the price took out the pending buy orders because those trading breakouts were opening long positions. At the same time, the stop losses of those who opened shorts are also buy orders. That's why liquidity on the buy side will always be found here, meaning above this level. Then, the price moved down and swept the stops on the sell side liquidity. And then, we're left with this level here. Before moving even lower, the price swept all those who opened short positions here, essentially clearing the train of traders. To absorb all the liquidity and allow big players to accumulate positions, they can't simply enter the market in one go like retail traders do. For us, trading is straightforward. We can open positions with any lot size, and there is always enough liquidity to execute our orders. But for big capital, the rules are different. They can't just enter the market all at once. They need to accumulate their positions gradually, and that's not easy. That's why these levels are algorithmically designed, so that price later returns to sweep them, helping the big players build their positions efficiently. Who exactly the big player is doesn't really matter, whether it's a market maker or a central bank. What is important for us is to understand how the mechanism works. If you want to dive deeper into this, you can look up CLS, an algorithm operating in the forex market. It's widely recognized for how it structures liquidity, the time frame it uses to accumulate and distribute positions, and so on. You can explore that world to learn more about who these market makers are. But for now, our main focus is grasping the core principle. To avoid confusion, let's not get bogged down in overly intricate details. Now, let's talk about liquidity pools. What are liquidity pools? Here we have what's called a swing high. We'll examine exactly what this means in the various next slide. For now, just imagine it as a certain level where liquidity accumulates. Think about it. Where would you place your stop loss if you've ever traded using technical analysis? That's exactly where liquidity will always gather. If we have a relatively equal low, it would look something like this. This is the level where even more liquidity accumulates. Why? Because traders opened long positions here, the price retraced, then more traders opened longs again at this level, seeing that it seems to hold. Of course, the price then rose precisely to sweep this liquidity before falling even lower. This is how these pools work. They attract orders, both stop losses and pending orders, which then gets harvested when price returns to these levels. The key takeaway: liquidity always clusters at the obvious technical levels, where traders place their stops and pending orders. Now let's understand what swing highs and swing lows are, how they are defined, and how to find them. If anyone is confused about liquidity, don't worry, because as soon as we combine market structure and liquidity, we'll immediately move to the charts and analyze this many more times. So let's look at what market structure is and start by defining swing highs and swing lows. A swing low consists of 3 candles, where the second candle is always lower than the first and the third. So it's all very simple and straightforward really. A swing high is also 3 candles, but it's the exact same situation just in the opposite direction, where the second candle is higher than the first and the third. And now let's move on to market structure and take a closer look. Let's imagine that we had the swing high right here. So The market moves, and as soon as we have 3 candles where the second is always higher than the first and the third, that will be our structural high. The low is the same thing, just reversed. The first and third candles will always be higher than the second. When the market moves and then pulls back, as soon as the first such 3 candles appear, where the second is lower than the first and the third, that will always be a structural low. And if we imagine an uptrend, these swing highs will consistently form higher and the swing lows will also rise. Each subsequent structural swing high will be higher than the previous one. Understanding market structure isn't that difficult. Firstly, because when the market is moving up, it's usually obvious that it's trending upward, and the liquidity factor is far more important than market structure. I will show you how to use market structure at key moments, meaning you won't need to constantly track and count every swing high and swing low. So how do we determine when the market is about to reverse? Let's take this little segment and start breaking it down together. Here we have 3 candles forming a structural low. The first candle is higher than the second and the third candle is higher than the second. So these 3 candles form a structural swing, in our case a low. And this candle here will be that structural low. Then the price moves up. This will be the structural high. Next, the price declines. We also see it here, right? But this will already be an internal structure. That is, we have a range here. For now, the price hasn't broken out of this range. Everything inside this range doesn't matter. What's important for us is understanding the overall structural range and focusing on key moments. That's far more critical than analyzing how prices moves within it. Because there are tons of fake breaks of structures, we'll break this down in detail later. There's a lot of manipulation and we'll aim to avoid it. That's why we will not dive too deep into this internal structure. It won't help you on its own. What's matter is simply understanding the direction and key levels. Most importantly, key timing. We need to focus on shifts in price delivery. So whatever happens inside this range doesn't interest us. Until this range is broken, we don't care about internal fluctuations. Now, here the range is broken. Price has exited this zone, and again we see 3 candles. The second candle is higher than the first and third. Then price declines, and once more we see the exact same pattern. If a structural high does not produce a structural low, we also skip it. That is, we wait until there is one that also forms a low from it. And if we now go back to the chart, we have an upward movement. And this whole pattern holds, right? The highs are rising and the lows are also updating upward. Then the market continues. What happens at this moment? It's called different things, BOS, BMS, whatever. For me, it's a market structure shift. Say highs were rising throughout this entire period. Everything kept rising, and then for the first time in this whole movement, we've broken this low. That is what a market shift is. When this happens, market transitions to the next phase. It was in an uptrend and shifts into a downtrend. However, this won't always be the case. In fact, more often than not, it will just be a fake liquidity grab, which we'll now also analyze in the context of market structure. Frequently, it will turn out to be a fake out, so you can't rely solely on this signal. You need to understand the market as a whole, and that's exactly what we'll do throughout this course. We'll gain all the necessary knowledge to avoid fake liquidity sweeps and truly grasp where the market is headed. In this particular case, it wasn't a fake breakout, and as soon as this first low was breached, we started moving downward, that's clear. In one candle, we have both a high and a low, which is usually rare, but it's worth noting that this was also the first time the high was lower. Next, we have another 3 candle swing here, followed by this one which formed this low. Let's go over the breakdown again, in case anyone got confused. So, during the uptrend, highs were rising and lows were also rising. The moment the first low is broken, meaning this low right here is breached, we shift downward. That's the key signal. The market structure changes when the sequence of higher highs and higher lows is interrupted by a lower low. After that, we watch for confirmation, like the next swing failing to make a new high or breaking another key level. That's when the downtrend gains validity. But remember, as mentioned earlier, sometimes this is just a liquidity grab before a reversal. That's why we always wait for additional confirmation, whether it's a follow-through move, a rejection of higher prices, or a break of structure in the opposite direction. In this case though, it wasn't a fake out, the breakdown held and the downtrend continued. This tells us that the market now wants to move in a different direction. Therefore, as soon as we see the first shift, it indicates a change in the market behavior, and then we observe that the highs are now declining, the lows are declining. This played out here this time, a good example. What's important to us are precisely these key moments, because during these moments we will be looking for trades. Now, an example of a shift to a long, meaning if there was a downtrend movement, how it will now transition into an upward one. Here, there was a downtrend. The low was updated once more, meaning this was the last high that produced the last low in this entire sequence. So now, let's move on to liquidity and examine everything together to better understand it all. So, for example, here we have a market. The market is moving down here. Right here we had liquidity. Why is there liquidity here? Because again, this structural high is here. So why do we even need structure? Primarily to determine where liquidity is. Here the price kept moving down, down and down. This last high was updated, creating this final low in the sequence. And then this high was taken out, which signals a change in the market behavior. But what is more important? What's more important is that liquidity was sitting here, and even though the market rallied here, it rallied here only to eventually drop again. We've started moving up, everything updates, everything moves up, but price is sweeping this liquidity, meaning the stops of those who shorted here, and this was a downtrend. Why wouldn't you short? A clean move down and everyone jumps in here, and stops are hidden behind this structural swing. The price rises and takes out these stops, and once they are cleared, it continues its move. That's when the breakdown happens here, and then it moves down. It takes out this low again, meaning it sweeps the liquidity that was sitting here. Below the last low, that's sell side liquidity now cleared, and then we reverse and impulsively rally upward. So if you had shorted here, for example, you could have taken a small trade here, and it would have worked out. But overall, no. You can't rely solely on structure without understanding liquidity, without understanding which liquidity pool the market will target next. So again, we had liquidity here, the trend was downward, price reversed, first it swept this liquidity, taking out all those who went long after the breakout. Then it continued down, clearing out everyone who was still holding long positions. Essentially, it cleaned the house before this impulsive upward move. The algorithm cleaned out everyone in the market, both shorts and longs. Only then did the price move upward. You see, there were actually two manipulations here. We'll analyze manipulations separately in great detail later, but fundamentally, all manipulation is primarily based on liquidity. So we can already start understanding this aspect too. This is the key factor. Here, everything worked clearly according to structure. Every breakdown essentially created opportunities for trades and was valid. There were no major fakeouts here. The price moved down, then broke structure, resulting in a decent upward move. Then we dropped again, another decent downward move. Then came the breakdown, and indeed we moved upward. The price truly went up. It kept climbing and climbing. We identified the price action here. Now let's move to the next concept, inefficiency. Since you stuck around until the end, I've got a special bonus for you. 3 trading strategies I've relied on for years, all with a proven edge. Chances are you've never come across these before, so I highly recommend testing them out, at least on a demo account. You will find the PDF with detailed instructions linked in the description below. Oh, and don't forget to hit that subscribe button and drop a like on this video if you found it helpful. Thanks for watching, and I'll see you in the next one.